Good morning, everyone. I am Lucina Nersisian, Chief Risk Officer and member of Management Board of Arçelik Bank. It's an honor to be the flagship sponsor of EBRD's annual meeting, held for the first time in Yerevan. We are happy to welcome all of you, our fellows and partners on this amazing event, and it's a great opportunity to present this very crucial and important topic of sanctions to the broader audience with the help of our esteemed guests. Let me present you our guests. Arakel Meliksetyan, Head of Financial Monitoring Center of Central Bank of Armenia. Welcome to the panel, Arakel. Elitsa Kavrakova, Group Head of Institutional Clients at Raiffeisen Bank International. Happy to have you with us, Elitsa. Marshall Smets, Executive Director at Argos Advisory and Audit. Thank you for your time, Marshall. Michael Strothman, Senior Legal Advisor on Financial Sanctions. Pleasure to host you, Michael. William Rich, Global Banking Head of Global Banking Client Risk Management Advisory, Sanction Compliance, Citi. So let's have started. Arakel, as the country head of financial monitoring, please share your thoughts on the agenda today and the topics that we'll discuss here.
Thank you, Lucina. I'll use my notes not to miss some important points here. Dear colleagues, good morning, and thank you for taking time to attend this panel discussion about economic and trade sanctions, a phenomenon that is 24 centuries old, but has become much more prevalent over the last decades. Put simply, economic and trade sanctions are restrictions imposed by intergovernmental structures and national governments to achieve foreign policy, national security, and crime reduction objectives. This is done by restricting economic activity of the sanctioned parties and isolating them from international and national finance and trade. Some of the specific measures that are relevant to financial institutions and particularly to banks include block financial transactions and investment, import and export controls on goods and services, asset freezes and seizures, and trade due to their unique position in the financial system, which touches upon many, if not all, aspects of an effective sanctions enforcement. Financing sanction due to their unique position in the financial system, which touches upon many, if not all, aspects of an effective sanctions enforcement. In a sense, banks serve as a focal point for implementation of various sanctions regimes, be it blocking of financial transactions and investments, or freezing assets, or restricting trade finance. In this context, public-private partnerships, which are strategic or operational arrangements between the private sector and the government agencies, can have a vital role in combating sanctions evasion. Such partnerships can be contractual, corporate, or collaborative in nature, and the role played by public and private sector entities can be flexible to meet specific requirements. Evasion is perhaps the natural response of the targets to the sanctions, and the typologies identified so far in evasion of sanctions include the use of complex ownership structures to disguise the ultimate beneficial owners behind the legal owners of an entity or an arrangement, as well as involvement of family members and close associates to ensure continued access to and control of assets, the use of enablers to avoid visible involvement and to leverage expertise, and the use of third-party jurisdictions and false trade information to facilitate shipment of sensitive goods to sanctioned jurisdictions, and the use of real estate to hold value and to benefit from wealth. So today we're going to discuss various aspects of the above stated issues, that is the role of financial institutions in ensuring sanctions compliance, the use of public-private partnership arrangements in combating sanctions evasion, and the efforts towards achieving transparency of beneficial owner information. With this, let me conclude my opening remarks and hand it over to our moderator, Lucine, to ask questions to distinguished guests who kindly agreed to share their insights and experience regarding the challenges, but also the practical solutions in complying with economic and trade sanctions. Thank you for your attention, and I wish all of us to have an interesting and fruitful discussion.
Thank you, Arakel. Eliza, since you are dealing a lot with both national and European regulators, I would like to ask your views on how do you see the effectiveness of regulatory oversight on sanctions?
Thank you. I think it's interesting that you asked me in respect of regulators, me coming from one of the major correspondent banks in the region. But it's a very important question. And in my view, the effectiveness of sanction compliance very much depends on effective implementation and controls. And here is the devil, because in my observation, compared to like 9 to 10 years ago, the sanction regimes which have been introduced in the last 2.5 years are so complex and were coming with such high speed that it was very difficult not only for the commercial banks, doesn't matter where they are on planet, to keep pace, but also for the regulators. And another observation was that in many cases, the regulators themselves were not fully aligned. So we had partially contradictory sanction rules, and again, this negatively impacts the implementation and control. Because of particularly last year, the topic of sanction circumvention risk through re-export of goods to third countries have been tremendously evolving. Here, in my view, it's very important, and I'm afraid we're not yet there, and happy to hear the views of my fellows at the panel. Essential for me is the cooperation, to accelerate the cooperation between a local regulator and other relevant state authorities like customs, because without accelerating this, we will never get to have an end-to-end view on the trade flow. And this would continue, I'm afraid, blocking or hindering the essential trade between the countries.
See. And now, William, where do you see the major risks related to the sanction of evasion, and where do you see the major risks for the banks specifically?
Sure. Thank you, and good morning, everyone. And I just want to say a quick thanks to Arch and Bank for bringing us together today and choosing this very, I think, timely and relevant topic, which is evidenced by how packed this room is. I think in terms of challenges for global banks like Citi, the first is, for a bank like Citi, where we operate in 70 jurisdictions, we provide services in over 100, integrating regulatory change and financial crime risk management is really sort of part and parcel of our DNA. It's something that, I think gives us a big comparative advantage. However, as Eliza alluded to, the sheer speed and scope of the changes that have happened in the last 2 years is really unprecedented. And to give you a sense of scale, I think most people are familiar with, before the Russia sanctions programs, the Iran sanctions. And the Russia sanctions program today is about 5 times larger than Iran. And the Iran program took about a decade to put in place. And the Russia program, about 98% of the sanctions have happened in the last 2 years. So we're talking about a very different, scale of the rate of change. And, large international banks are very good at putting in control processes. They're not as good at, changing those control processes very quickly. And I think that that's made even harder by the second challenge, which is divergence in the sanctions programs themselves across jurisdictions. So, at the G7 level, there is a lot of consistency in the policy of the response to Russia's invasion of Ukraine. However, in the sanctions programs of predominantly the US, the UK, and the EU, there's a fair amount of divergence both in terms of what is restricted and what is exempted from restrictions that makes life pretty difficult for a bank like Citi that operates in all of those jurisdictions. And the final challenge I would touch on is really, I would say, taking that second challenge of differences between jurisdictions to a bit of an extreme, and that is conflict of law, which we're experiencing much more these days than we used to in the past. Now, every jurisdiction has the ability to exert its own sovereignty and implement its own laws, but the nature of sanctions and some of the extraterritorial aspects of them have resulted in situations where, in many countries where complying with foreign sanctions is banned, it can make for some difficult conversations with our clients or our regulators. And, the nature of the targets of the Russia program, I think, exacerbate that a little bit because with Iran or North Korea or Syria, some of the other big programs, the types of targets weren't multinational corporations. They weren't banks with a large global footprint. With Russia, they are. And so we have all sorts of risks and conflicts popping up in places that we've never had them before.
Yeah. Marshall, what is your opinion? The reason behind some of the major flaws and failures that the banks faced and we actually have witnessed also publicly.
Good morning, Christine. Good morning, all. Obviously, each case is different and every bank is different, but I will try to summarize and I will see mainly 3 reasons for those flaws. The first one, this is related with the big cases, the ones that are really hitting the press, which fortunately are very few. But this would be related with cultural issues. So I'm referring, for instance, we have seen in the previous months Binance, which has been fined for around 4 billion. That's cultural issue. When I speak about cultural issues, I'm speaking about the company culture. So that's a company who was thinking that they can have a way to avoid to fully implement the sanctions. So that's the first one, which fortunately is extremely limited. It's big cases, but very limited in terms of numbers. The second reason I would see is basically lack of understanding of the requirements. We've seen a lot of European banks which have been fined for activities between 2008 and 2012, which were mainly related with Iranian breaches, because there was some conflict in the regulation and some different perception in Europe of what should be done to really implement it. We can even speak, for a case that I know from close in UniCredit, where they were receiving at that time, when they were doing some legal assessment, opinion from very reputable legal firm telling that this is feasible, but you have to pay attention to this and maybe that, and, well, in other words, something which is not usable by the business or by compliance people in order to understand that's how it should be done, that's what you can do, that's what you cannot do, and here is the line. So the second reason is lack of understanding of those legal requirements. From my perspective, we are living exactly in the same context today because of, as Elitza and as Bill mentioned, the amount of new regulation that we've seen in the past 2 years is absolutely unprecedented. So it means that for everyone, regulators and banks, it's extremely complex to understand exactly what it means in terms of controls. And even I think sometimes the people who are issuing the regulation do not know exactly how it's possible to implement this, how it's possible to have the right control in place. So that's the second point. Then the third reason that I would see is lack of oversight on the process that we have to control sanctions. It's quite frequent that speaking with banks and asking them, are they in compliance with sanctions? And then the people are saying, yes, of course, we are. Then when we go to the detail about understanding what is the control process that you have in place, what is the testing that you have, do you have a quality assurance, then you start to see the issues. Because sanctions, this is not something that can be added to the AML team. You need to have a specific sanctions control framework in place. It's not an additional task that are given to the AML heads. But this is something that has to be thought in terms of sanctions control. So this would be the three main reasons that I would see, Lucine.
Yeah, thank you. Another aspect that complicates our life even further is that we have witnessed several cases when the clients have challenged the banks for their actions related to AML or sanctions specifically. And in this aspect, what do you think we could do in order to mitigate ourselves from those risks?
I would be surprised if we don't get challenged either by our clients nor by business internally. And actually I would be surprised if we are not being challenged by someone. Then this may actually raise a red flag and say that this person probably needs the account, whatever happens, or the business definitely wants to do this and we should look deeper into this. So just to probably repeat what has been said already, we need to create a level of understanding that is much better. We need to create this level within banks, within companies that do business with us, and we also need to create a better level of understanding when it comes to the regulators. Because as soon as you have a big company, you have a lot of people who can do this, who can get detailed knowledge of it over time. When we look at Iran, for 10 years at some point, you will have some institutional memory. This doesn't exist with Russia right now, where you have all those different levels of new sanctions that have been unprecedented before. And then, of course, you have a smaller company who will come to a bank and say, I have always done this business. I would like to still do this. Why is this wrong all of a sudden? And then you need to explain this. And then also the role of the AML and sanctions departments, and it should be, as Marshall said, a specific sanctions department in a big bank, needs to explain how can you do this and what has changed. And this usually creates a level of confidence and trust between the client and the bank as well, because then they feel they are in good hands. And this is probably the biggest mitigator of any risk that you have in this instance.
And coming back to the major risks, Elitsa, you being responsible for correspondent banking and major European bank, what do you think we can, face, and what is the major shortcoming potentially for the banks, for FIs that you deal with?
I can speak for hours on this topic. I'll try to nail it down to the top three major points or messages to give. Number one, the correspondent banking ceased a while ago to be only about payments. It needs to be treated strategically within a bank, particularly I'm addressing here the respondent banks in the emerging markets. It needs the senior management attention, and it needs investment. And I think here there is still space to improve. Number two, and we heard this already, I think Marshall mentioned it, it's about risk appetite. Means to know the risk appetite of your, in brackets, potential correspondents down the road, and to be able to define your own risk appetite. Why I'm saying this? Because the risk appetite of a correspondent bank is also based on several factors. It's like the own business model, the risk-taking capacity, system-taking capacity, and also other correspondents behind down the road. So this is the KYCC interpreted like know your correspondent's correspondent. Yeah. And then, based on the risk appetite of your correspondents, you as a respondent bank need to be able to define your own risk appetite. You can't onboard anyone on planet. You need to know whom do you want to onboard. And again, this is a function of what type of payments you can send to your correspondents, because again, everything is connected. So we need to be able to match the risk appetite of every single correspondent to the risk appetite of the respondent bank. And I come now to the point number 3 for that, and again, addressing more the respondent banks. You need to be able to work with the data. So out of your core banking system, you need to be able to extract the data. So it's about automatization and digitization and making it everything more digital. Because when I tell you, as a correspondent bank, I would like to see, transaction flow in, this type of industry or that other type of industry, still many are not able to extract these type of payments from their core banking system and say, I'm not able to. I have the data, but I can't work with them. So these are, it's about data,
So in this context, Arakel, how would you define the relevance of sanction in the AML-CFT framework? And what are the practical, maybe, mechanisms to ensure their effectiveness?
Thank you, Lucina. I believe we have to differentiate between 2 broad categories of sanctions. And the first broad category is the international sanctions imposed by the United Nations Security Council resolutions, such as Resolution 1267 on Taliban or 1989 on Al-Qaeda. So these type of sanctions, which we also call targeted financial sanctions for combating the financing of terrorism and the proliferation of the weapons of mass destruction, these are mandatory for all UN members. They are embedded in recommendations 6 and 7 of the FATF, the Financial Action Task Force, which is the global standard setter in the area of AML-CFT. So these are mandatory, and countries are assessed from time to time by the FATF or by FSRBs, FATF-style regional bodies, which is the Council of Europe Moneyval Committee for this region. The second type of sanctions, they are imposed by supranational structures like the European Union or by the big players, by the big powers such as the United States. So although there is no international standard or requirement to comply with this type of sanctions, in real life they have the secondary effect, or as my colleague stated, the extraterritorial effect. And for third parties, this effect may have very serious and significant effects in terms of financial losses and reputational damage. So the message is that all the mechanisms and tools that are used by the banks for complying with international targeted financial sanctions should be identically and equally used for ensuring compliance with the second category of sanctions. And for me personally, here it comes to the issue which I call a matter of appetite and digestion. Like, imagine you have the appetite, or the bank has the appetite of eating a buffalo, and its stomach is not big enough to digest it. So the right balance is where the risk appetite, or the need for making money, meets the ability to digest or to mitigate or to minimize the risk to an acceptable level.
Very important to comply the menu and the appetite together, right?
Absolutely. I mean, the counterbalance is the prerequisite for good health.
And Marshall, considering the recent sanctions on Russia, what would be the best practices the financial institutions should put in place so that we could effectively control the import-export potential evasions and restrictions?
Thanks for the question, Lucini, because I think that's the most difficult to answer. and that's where, obviously, a lot of circumvention is happening today. And that's where we know perfectly that US authorities and EU authorities are very much focused, is how we can ensure that there is as less as possible circumvention of import and export. Speaking with the banks, usually there is very good level of control of what would be exchanged directly with Russia. So usually there is quite a lot of focus, and they understand what is happening directly between a third country. When I say a third country, I mean a non-EU, non-US. Usually they have quite a lot of focus and control in what would be direct exchange between their own country and Russia. And even more, if they are dealing with a client that would be on one side importing from Europe, exporting to Russia. So this, I think, is very well controlled, and there is almost no circumvention happening via that way. But this would be, of course, far too easy. If right after March 2022, we have seen circumvention that were just, doing from Europe to a third country, from the third country to Russia, now we have seen quite a lot of change on this. And of course, people on the other side who are trying to circumvent, every day they try to find new ways. So the main issue is layering. And when I say layering, is that there is one company who is importing, they're selling to another local company, and that local company would be exporting. So we need to be able to connect the dots. This can be done by layering in different banks. This can be done by layering in different countries. So we have seen a lot of circumvention, which is now from Europe to a third country, in the Caucasus region, for instance. From that country, it would be further exported in Central Asia. And then from Central Asia, it could end in Russia. So it means that in order to be able to control this appropriately, we need to understand the end-to-end transaction. When you have one payment that you see, you need to understand where it started and where it ends. So it's almost like, and when I say almost, not to afraid too much the people, it means that for all the payments, we need to apply the same due diligence as for trade finance. Understand the origin, understand the destination, understand the routes, understand all of the details of the transaction for almost any single payment, which is obviously extremely, extremely complex and time-consuming for the banks. And to add an additional issue, I think you have all seen the latest regulatory developments in December last year with there is the Executive Order 14114, which is highlighting very much the challenges for the foreign financial institution, which mainly is telling you that any type of involvement with the Russian economy could lead to sanctions, which is, I think, another level of complexity. And for this, then, I don't think that it means that we have to stop everything, but it means that we have to develop specific risk assessment for all type of economic relationship with Russia. So it's really, I think, an additional layer of complexity.
Yeah, things are not getting easier.
No.
To add here to what Marshall said, particularly on the end-to-end, it's very important now. Speaking about my practical experience on a daily basis. Well, I think it's still easier on the payment side to have the end-to-end view. Where we struggle currently, it's on the trade finance side, because currently I can only rely on what our corporate client is saying and documents presented and what the issuing bank is confirming me. But in essence, right now, I'm not sure we have a tool to control where is the real end destination of the goods, because, and I refer to what I was saying, we don't have an online monitoring of goods incoming and outgoing. Yeah? And I'm not aware of any also fintech provider who is offering a tool to that. My regulator, so legally, my obligation as a confirming bank and the trade finance is ending up with the issuing bank, or eventually with their, with the ordering party. My regulator, however, requires me to know until the ultimate destination of goods, which objectively, I, as a commercial bank, am not able to know right now. So that's the biggest difficulty. And so fully, just to underline what you're saying, very important. And right now, we are not yet there. Yeah.
And exactly this is the reason why we in our banks have tripled our AML and sanction stuff, because all of this is currently done just manually and we don't have a software to control that. And William, as a representative of a major American bank, what would you say on this?
So, I think the challenge has been very accurately described. I think we are trying some innovative ways of using data, but even when there is trade data available, it's not real time. And so, we're oftentimes working with at least a couple days, if not a couple weeks or months, which, for sanctions compliance is not good enough. Sanctions compliance is a real-time, continuous responsibility. In AML, you can sort of, work post facto. And I think adding to the complication is, the real development in sanctions, and I think we're going to get to this a little later, but I think this leads into it quite well, which is that in the EU and UK, they have introduced what they call trade sanctions, sometimes referred to as trade restrictive measures. And for large financial institutions, sanctions controls, export controls are something that we've been dealing with for 20, 30 years. There are risk assessments and controls and training and things that have been in place for a long time. The advent of trade controls of trade sanctions is quite different, because when you think of export controls, the obligations are on the exporter and on the goods themselves. Whereas with trade sanctions, there is a link to the financing of that trade, which by definition implicates the financial institutions involved. And I think early on with the introduction of these measures, people took a look at them and said, okay, they're the same as financial sanctions. Let's just introduce more information about goods into payment screening. And it was incredibly ineffective. Adding more data into payment screening resulted in a lot more false positives, but not necessarily a lot of risk mitigation. And so, it's an area where I think we're looking for additional guidance, and we're looking for additional best practice, because I don't think any bank has really mastered complying with these trade sanctions. And it's really a work in progress. And the only real solution we've been able to provide is better knowing our customers that are engaged in this type of trade, which could trigger trade sanctions, to introduce additional questions when a deal or transaction comes up for review, and then really training our first line staff and our operational staff to escalate when they see something that could implicate trade sanctions, particularly in countries where there may be capital controls or something that gives us access to additional information that we won't have in the normal course of business. But it's something that I think remains a real work in progress.
You mentioned knowing the client. And so in this context, Arakil, what about the accuracy and the quality of the beneficial ownership and the transparency regarding it?
Thank you.
The importance and,
Yes.
the flaws over there.
You have to know who your client is. And as we've already mentioned, complex ownership structures are a prevalent typology to disguise the actual beneficial owners of a legal person or an arrangement. And this has been misused many times for sanctions evasion as well as for money laundering and terrorist financing. So in March 2023, the FATF has issued its revised guidance on the beneficial ownership of legal persons, reiterating the need for understanding and assessing the risk associated with legal persons, so as to enable application of appropriate mitigation measures. So distinction between beneficial owners and the legal owners is considered critically important, as the legal title or controlling shareholding of a company may be in the name of an individual or a legal entity or arrangement that which is different from the beneficial owner, who ultimately controls the company either directly or indirectly. And such control can be exercised, and I'm quoting, through ownership interests, differential voting rights, the power to appoint the majority of senior management, through debt instruments, positions held within a legal person, or even through informal means, that is, through close personal connections to relatives and or associates. So, furthermore, when an individual is using, enjoying, or benefiting from the assets owned by a legal person, it could give a ground for further investigation, further enhanced due diligence, so as to understand whether the individual is in the position to exercise control over a legal person. Just imagine a situation that your client is a company which provides maintenance services for some luxury real estate or yachts or planes. So technically, neither the customer is designated under any lists, nor the assets are arrested or frozen or, under any restrictions. But in fact, the people who use or benefit from the use of those assets may be the very heroes or targets of the different sanctioning regimes. So enhanced due diligence is needed to make sure that your financial institution does not suffer the consequences of what we call the secondary effect of the sanctions.
Thank you. And another interesting example, a complicated one, for example, that I would like to discuss is when for a family member there is a trust and the potential UBO member families are the beneficiaries of the trust, and there is a protector and a council members. So legally, what aspects should we consider in order for this kind of hard case to define who is the UBO?
Usually we will have the laws of the trust, whether it's set up, be it in Cyprus, be it in Liechtenstein, or be it in any other Bahamas vacation destination, as I would like to call it. And they will exactly tell me who is the beneficial owner under this system. And when I'm approached as a bank by a client, they usually will have the exact documentation ready that proves on paper that this person is the UBO. And usually this family will not come just by themselves. They will come with a lawyer. They will come with a legal opinion exactly telling me that under the laws of this other country, this person now is the UBO. And then I may also have, be it in Germany or any other European destination, an AML law which tells me what I need to do. Do I need to identify, verify, or where is the UBO? And now here, this is not really legal, this is gut feeling, because as soon as I feel that the source of wealth is actually family member A, who happens to be on a sanctions list, but then family member B, who is 40 years younger than this person and as a major accomplishment in life has probably been on a pop show or somewhere, and that's all it is, and now this person is allegedly running a multinational company, I may have questions. So, and as soon as I have these red flags, the easiest thing as a bank right now, and probably the best thing to do, is to simply deny opening an account or denying continuing any business relationship. Now, another layer of complexity that I would like to mention here is that especially for the European sanctions, technically it would be the European Union who is interpreting who actually is sanctioned or who is entitled to any benefits or restrictions. But in Europe you have all the member states and you have those nationally controlling authorities, and there we see an issue, especially with these complex structures, where one country says the final UBO is person X, while another country in Europe says no, it's person Y. If you're a multinational bank, you may have an issue that in Germany, you have to consider person X to be the UBO, while in Italy, you have to consider person Y to be the UBO. But it's the same European restriction that you are facing. So this is something where we need to work on the alignment issue among the US, the UK, and the Europeans, but the Europeans among themselves at first, that there is something that Kissinger once called that there needs to be a number I can call in Europe to get me an answer.
Another interesting aspect that I think deserves a discussion is complex businesses like cryptocurrency transactions or online platform trade, where it's pretty challenging to define who are the buyers or to control the cash flows. So what would you say about this, William?
So I want to quickly, before I answer that, sort of add a comment that I think dovetails well with what was just said, in that in a lot of ways, so one of the I think things that we oftentimes confront in the implementation of sanctions that's very difficult is the fact that it's not just the people on the list that are getting sanctioned, it's everything that they majority own. And there's a real divergence between how the US, the EU, and the UK interpret that sort of majority-owned entity extension of sanctions. And, ultimate beneficial ownership is, in a lot of ways, relatively easy to establish because there's a documentary history to it. The question of establishing control is one that I continue to be in sort of never-ending discussions around, what constitutes control. And to share a real example of where this was relevant, we had a direct client that was partially owned by an SDN in Europe, and they came in with a 50-page law firm brief explaining how they were completely removed from the operations of the bank, and the bank or company, I don't remember actually, but they were completely removed, had no influence whatsoever. And then as we were performing our control analysis, I got a phone call from one of our correspondent banks saying that this entity had asked to open an account, and the SDN, who is a board member, showed up at their chairman's office to explain what they wanted to do with that account. And it completely sort of upended our analysis. And I think those questions of influence are really challenging because when that changes, there's not necessarily a bill of sale or something that you can use to establish whether someone is an owner. If they're just someone that's in control, that can be a very subjective analysis at sometimes. So and that really comes into play with the EU and the UK sanctions. The US sanctions are much more about just direct ownership. With respect to the question you asked on crypto and online marketplaces, crypto is really an area that the city doesn't engage with primarily, and at least in sort of direct activities. So it's hard for me to speak to that. But in terms of online marketplaces, there's just been an absolute explosion in the amount of payments going through online marketplaces, and that's really driven by consumer demand. It's what consumers want, and it's becoming an ever greater share of the global payment flows. And for these online marketplaces, or sometimes we refer to them as payment intermediaries, it's a situation very similar to correspondent banking, where we understand our customer, but we may not have direct access to information about their customer. And that can be very difficult because that may limit the effectiveness of things like payment screening. And so it becomes extremely important to understand the controls that your customer uses, their customer base selection, what their target market is, what the business model is, and does it make sense with sort of your risk appetite. And then very quickly, when you establish a relationship, getting a sense of what normal looks like. so that when there is anomalous activity or something that needs to be investigated, you can spot it pretty quickly, and you have a good enough relationship, sort of compliance department to compliance department, to be able to, call or email over and solicit information to either get you comfortable with the activity or to ask that it ceases.
And Marshall, would you? Yeah, sure.
Does it mean that the bank, Citibank, does not de-risk itself, and that you have customers that are virtual asset service providers or crypto asset service providers?
So no, I'm not aware of any VASP clients at this point. It's a market we're just not in. My comments were more specific to online marketplaces. So, without naming any clients, things similar to the Amazons of the world, the Alipay's or AliExpress, and those types of things.
Why am I saying this? And I'll do a brief promotion campaign for Central Bank. So there are different approaches in the world as regards the virtual asset or crypto asset services business. So one of the approaches is to forbid or ban any relationships with crypto and crypto asset service providers, such as the regime introduced in China, for example, although I don't know how effective it is. So the other approach is the sort of light regulation, just registering the VASPs and letting them do their work without any appropriate controls. And the third approach is the full scope licensing registration. That is basically what is the requirement of the FATF recommendation 15 as revised in 2023. So our country has firmly decided, and the governor will confirm this, I guess, has firmly decided to implement the full scope, comprehensive regulation of the virtual assets and crypto assets and crypto asset service providers by implementing all the applicable requirements for market entry, including fit and proper checks, then for customer due diligence, know your customer, record keeping, and even the travel rule, which is perhaps the most painful aspect of successfully implementing regulation.
Marshall, what would you comment on this?
Obviously, we know that crypto today it is the main tool which is used to move funds out of Russia or in Russia. Because of all of the actions that have been taken at the SWIFT level, now it's much cheaper for people who want to receive money from Russia to use crypto services. And this will not always go via formal VASP, but this can be managed only via peer-to-peer transaction. And it's only individuals who would be dealing with this in your local market. So you, as a bank, or as a compliance head in a bank, you will even not see that this is a crypto-related transaction. So this is becoming extremely, extremely complex. Now, of course, it's a very smart move to go for full regulation implementation in relation with crypto to try to have as much control as possible on this. Now, from the bank side, it's key, as Bill mentioned, that you as a banker, when you deal with a VASP, you understand exactly what is their sanctions compliance framework. So you need to understand their policies, their controls, their internal controls in order to understand exactly their risk appetite and what they do. So the first thing is to make that assessment, which is from a KYC perspective. The second point is that you need to be able to control this. So you need to have tools internally to ensure that what has been defined in terms of KYC, it's effectively what is happening via the account. That's the second point, control. And then the third element is that you need to be able to test this, to make some quality assurance from time to time to ensure that you can go one level down to make an additional deep dive to really make sure that this is what is happening. So it's pretty complex and time-consuming. So it means that for the bank who have a risk appetite to accept crypto, you need to have specialists to understand exactly that word. You need to have the specific tools that would allow you to understand what is happening. So there is quite a lot of investment that you have to do in order to accept this type of transaction.
So it's always about the appetite and stomach to be aligned, right?
And the investments,
Yeah.
yes.
And if I can just add a comment about maybe why we haven't been able to get very comfortable with VASPs is, I think in a sort of product area where it's completely decentralized, there is no intermediation where you can sort of rely on the controls of a partner like with correspondent banking. It's really the weakest link that determines the overall security of the cryptocurrency or decentralized service, whatever that is. And I think one of the things that we've been watching closely with respect to the Russia sanctions, Iran sanctions, is the advent of over-the-counter services with respect to crypto. And so these are face-to-face transactions that get recorded on a crypto ledger, but you don't necessarily know the ultimate beneficiary, the ultimate originator of the transaction. And it's such a difficult thing to control for. We haven't been able to get to a place where the risk is sort of worth the benefit of the business.
Thank you. And Elita, as a major European bank representative, what would you say? I mean, are there maybe complex businesses that create higher risk of sanctions circumvention or these exact topics?
Well, I mean, I think my response will be rather short. The more complex the business, the more inherent risk, compliance risk. So that's a general statement. If you ask me if there is any product which may be a less compliance or less sanction risk, there is none. In essence, I think the transactional-based products means cash and trade will continue to be those which are, from sanctions perspective, in the spotlight. But again, complexity is always, doesn't matter if sanction or AML, so it's always compliance relevant, even more compliance relevant than anything else. From my business perspective, the simpler the better.
Michael, in this, considering these discussions we had already, what do you think, what kind of additional legal knowledge that the banks, AML people and sanction people should have in order to tackle potentially problematic aspects of sanctions circumvention?
I don't think we need to change the laws that we have so much. It's more that we need to change or get more experience on something or create more understanding among all the market key players, and also have further discussions and interactions with everyone, so that everyone who wants to comply with the laws, and this is 99.some% of the entire population, gets together and can create a system where this works. Because every time when we have this crypto is perfectly legal, and it may be used for perfectly legal transactions. The same is true when we look at circumventions. Certain legs of any transaction that is used for circumvention is entirely legal. And we can keep this, and this is within the risk appetite of every bank, probably, most banks, I would say. But here, we need to be better equipped and have a better understanding, and everyone needs to know what is legal and what is not legal, but we don't need new laws that piled up so quickly that nobody understands them to begin with.
Yeah?
Yeah, I think one of the key points there, to really enhance this is get more data, being able to use the data. So this is why in the current context, I think all banks, in function of their risk profile, needs to think about which tool they have in place and how they can basically invent or reinvent the controls that are in place in order to ensure that we have the proper control. But data is key, and use of the data.
And I guess many of the banks are now considering maybe artificial intelligence to be employed, although it might be pretty complex to start discussing it. I would suggest that we continue with the questions and answers if there are people who would, I see many of those. Please.
Hello. Aceh Gabrielian, Arching Bank board member. I have two questions. Number one, my question is to... being in big international banks who have a lot of correspondent accounts, and given all this machinery of compliance, and even if the Russian sanctions are over, there will be new ones. They're going to be even more complicated to know your customer rules, etc., etc. As a result of it, what is your incentive to deal with challenger banks? Because there is a cost to have a big compliance function, and as a result of it, the challenger banks are going to have, as a result, I think I have some magnetic field. Small challenger banks are going to have bigger risk appetite. And as a result, they are not going to have the same capacity, and there is going to be natural inclination for you not to work with them. Do you believe that this compliance function that is going to be ossified, because even without any country being under sanctions, this is going to pile up and become part of standard operating procedures? Does it mean that you are going to have more concentration and you are going to be much more pickier with your correspondent banking cooperators, and as a result, you are going to deal with less and less banks?
So I think it's a very good question, and maybe I'll start, and I'm sure Elitsa will have a view. In a lot of ways, it's too early to tell. It's because it's been only 2 years in this, greatly escalated sanctions risk environment. I don't think we've necessarily seen sort of the situation settle enough to know, to be able to sort of predict the future and predict sort of the macro effects of what that will mean for our correspondent banking business. I think, fundamentally correspondent banking is a relationship built on trust. And so, what it means to get comfort with your correspondent banking partner is something that evolves over time. And I think, it's always been hard to start a new correspondent banking relationship, because you have to get to that minimum level of trust before you can really start engaging in a business where, in a lot of ways, you have a dependency on the compliance controls, compliance training, and environment of your partner. And so what I will say is that I do think the expectations are going up on what our correspondent bank partners are doing. And we're having a lot of conversations. And I think one of the things that we really pride ourselves on is that these are two-way conversations, that Citi is expressing its risk appetite and getting an understanding of what our partners are doing. Because I think the biggest difficulty is where there's a disconnect between the correspondent banking partner and Citi, and we don't understand why they're doing something, and ultimately we have to take sort of a risk-based approach, and if we see something that seems anomalous and maybe outside of our risk appetite, we have to take action pretty quickly. And so by being proactive about the conversations with our partners, I think we've done a pretty good job of sort of letting them know where we are and listening to them about where their challenges are, what they're struggling with in terms of implementation of sanctions or AML rules. We can't directly advise them on how to do that, but I think having a common understanding and having a compliance to compliance relationship where issues and questions can be escalated mitigates, I think, a large amount of maybe de-risking that could happen as a result.
Thank you so much. I have to say, the time flies so fast. And unfortunately, we have to conclude here. Thank you so much to our esteemed guests and to all the audience, and for your spirit and for your knowledge and energy to make this meeting and panel memorable and really, really good. Thank you so much.